Now, after nearly a decade of interest rate repression by the Fed, there are about $32 trillion in U.S. business debts outstanding, according to the Federal Reserve. This debt is owed by non-financial businesses from mom and pop operations to Apple, and by financial corporations such as banks and financing companies. Business debts alone are up 40% from 5 years ago. Never have U.S. businesses been burdened by so much debt. This $32 trillion in business debt is over twice as big as the total household debt in the U.S., including consumer debt and mortgage debt. This mortgage debt blew up last time and was one of the factors that triggered the financial crisis and threatened to topple the financial system globally. But it was only $10 trillion. Today's business debt is bigger and badder than mortgage debt had ever been. So when it blows up, will it trigger the next financial crisis? Ladies and gentlemen, I'm Wolf Richter of WOLFSTREET.com, and you're listening to the Wolf Street Report. This $32 trillion in corporate debt and business debts includes all kinds of bank loans and syndicated loans, such as leveraged loans, and it includes bonds. Some of this debt is publicly traded, other portions are held by banks, and other portions have been packaged into asset-backed securities that are also publicly traded. These $32 trillion in corporate debt are, by definition, income-producing assets in investors' portfolios, pension funds, banks, etc., with plenty of corporations holding each other's debts, such as Apple owning bonds issued by other companies. When this debt blows up, the assets blow up. But what can make this debt blow up? A combination of rising interest rates, which is what they've been doing for the past 2 years, too much debt, and negative cash flows can cause a lot of stress for companies. Once that stress becomes obvious, banks and investors refuse to fund those companies further. That cuts the business off from fuel, and default is next. When companies have negative cash flows, and this includes luminaries like Netflix, they have to borrow more money to fund their operations and make the interest payments. And when this debt comes due, they have to refinance that debt, or roll over this debt, as we call it. When businesses cannot make interest payments, or when they cannot refinance that debt, they will default on their debts. In the best case scenario, this will trigger a debt restructuring either outside of bankruptcy court or under the supervision of a bankruptcy judge. In the worst case scenario, Toys R Us is an example, and Sears Holdings will be an example, it will lead to liquidation of the company's assets. In most debt restructurings, shareholders are wiped out, and the creditors who own this debt as an income-producing asset face varying fates depending on how high this debt is in the capital structure. Bank loans secured by good collateral near the top of the capital structure may recover the most, and unsecured debt at the bottom of the capital structure might end up being worthless. Going forward, businesses face two problems with refinancing their debts. They must not only be able to refinance their debts, but they also must do so at much higher interest rates. This includes every company from Apple on down. Apple squandered much of its cash with share buybacks, and it borrowed heavily to finance more share buybacks, and now it sits on $115 billion in debt, up from almost nothing before its wave of share buybacks. And when these bonds mature, Apple too has to refinance them at higher interest rates. Apple's balance sheet is still in great shape, and for now it won't have any problems making interest payments or refinancing its debts at higher rates when they come due, though those higher interest payments will eat into its profits. There are plenty of companies like Apple that will essentially be left unscathed by the credit downturn over the next few years. Then there are companies like GE. Once the most valuable company in America, it is currently dismembering itself to sell itself off in pieces in order to deal with its $135 billion in long and short-term debts. GE is still rated investment grade, but is facing a downgrade to junk. Then there are the companies that are already junk rated, such as Netflix and Tesla and a whole slew of companies in the shale oil sector and many others that have negative cash flows. They too will have to refinance their debt at higher rates. But in addition, because they're cash flow negative, they will have to borrow additional amounts just to fuel the cash burn machines on a daily basis. As interest rates rise and as credit markets tighten, these companies will face more scrutiny, and this is already happening. So, how could corporate debt trigger a financial crisis? Let's look for a moment at what happened to mortgages during the financial crisis. There was about 10 trillion of mortgage-related debt just before the financial crisis. Then 10 million people lost their jobs over a period of 2 years. Housing prices crashed and households and investors defaulted on the mortgages. All this happened within about 3 years, and banks were at the center of the action. For business debt, the vulnerabilities and timing are different. Corporate debt has to be rolled over when it matures. This may be many years down the road, in 5 years or 10 years or longer. Encouraged by the historically low interest rates over the past years, companies have successfully rejiggered their maturities, issuing new debt that matures further in the future. Each year, some of this debt is coming due, but only a small portion of it. So the number of companies that cannot roll over their debts and that therefore default would cascade through the years as those debts mature. Some companies will default next year, with more to do so in 2020 and more in 2021 and more in 2022 and so on. In other words, the pain will be spread over 6 or 7 or more years, and the maturities of those debts define that pace. And due to these historically low interest rates, companies were able to lengthen the maturities of their debts, and so this pace will be a lot slower and more spread out. Still, some companies won't be able to make the interest payments, and those end up defaulting right away. The problem of not being able to make interest payments gets a lot worse when the economy slows down or when a specific sector hits some rough spots, such as oil and gas right now. Oil and gas debt is already spiraling lower. Rough spots like these or an overall deteriorating economy will speed up defaults. But companies must be in really bad shape if they cannot make interest payments. At that point, they're on the last leg. They must already have been cut off from bank lending and from credit markets, and they would be unable to borrow more to make their interest payments. And for now, not that many companies are in this bad a shape. CS Holdings was in that group. So who gets hit when businesses default? Banks get hit when businesses default on bank loans. Bank loans are usually secured by the best collateral the company has. And for banks, it means that it can sell the collateral and recover a big part of the loan value. The rest is a loss. But banks have also sold off a big chunk of their business loans and securitized another big chunk. And these instruments are now owned by pension funds around the globe and by loan funds in your portfolio, etc. The risks have been spread from the banks to investors far and wide, and the damage to banks will be smaller. In terms of corporate bonds, they're generally not owned by the banks. They're owned by investors around the globe, and when these bonds blow up, the shrapnel will hit mostly these entities instead of the banks. So these two factors combined, one, the long drawn-out period when bonds have to be refinanced, and two, that the banks are holding only part of the risk, will limit the pain for the banks and spread it over many years. This will cause losses for the banks, and it will eat into their capital buffers, and it will cause gray hairs among executives and regulators, and it will cause the shares to be sold off, but it will likely not trigger a financial crisis. But wait, before we breathe this gigantic sigh of relief, let's think for a moment about what it will do to stocks. The fundamental principle is this: when a company is unable to deal with its debts, stockholders are the first in line to be dispossessed. When a company defaults on its debts, shares collapse. When it then restructures its debts in bankruptcy court, shares generally are canceled. Just like that. They might still trade on pink sheets, but they no longer represent anything. Instead, there will be new shareholders of the restructured company, namely the stiffed creditors. It will hit company after company, spread out over the next 5 to 7 years. Until this debt overhang is restructured and cleaned out, stocks will take a methodical beating on a company-by-company basis. This is in addition to any general downdraft in the stock market, and it's one of the reasons why I've been saying that the destruction of stock market indices will be drawn out over many years to make for a miserable and frustrating experience for stock market investors for years to come. And bond market investors are getting hit too. After years of the everything bubble, there are not a lot of places left to hide, and even well-diversified portfolios will get hit from multiple sides. But hey, we can't complain. We've had it so good for such a long time. Ladies and gentlemen, I'm Wolf Richter of WOLFSTREET.com, and you've been listening to the Wolf Street Report.